Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. No more extensions. Donald Trump ramps up his trade war, threatening 200% tariffs on pharmaceuticals and 50% on copper. The metal's US futures jumped the most on record. Emmanuel Macron warns of hesitating alliances as he says the UK and France have a special responsibility for Europe's security. Plus, UniCredit ramps up its stake in Commerzbank to 20%, becoming the biggest shareholder in the bank it hopes to take over. Good morning, happy Wednesday. So amidst renewed tariff and Trump uncertainty on the trade front, you have European futures pointing to a third straight day of gains. 2 days of gains, European 50 futures pointing to further upside of 0.3%. It's been modest, but the upside has been there for the European equity space. FTSE 100 futures here in the UK looking to add 19 points so far as we lead up to the open at 8 a.m. UK time. S&P E-mini stateside, a little flat, just down 0.1%. It was a flat session, a flat close for both the S&P 500 and the Nasdaq by the end of the day on Tuesday stateside. Nasdaq 100 futures pointing to just a 5-point loss so far. Both of those major indexes, it seems, looking for direction. Let's flip the board and have a look cross-asset then. A little bit more movement in terms of the Treasury markets. You've got the 30-year closing in on 5%. You've had 5 straight sessions of selling pressure across US Treasuries. The 10-year is now at 4.41. Yields up 1 basis point. So that continues in the session today, particularly at the long end. Globally, we have seen that waning appetite, of course. And you've seen that reflected in the Japanese bond markets as well. Euro-dollar 117 on the single currency, down a little bit on dollar strength in the session, just down 0.1%. Brent at 69.96, closing into $70 a barrel. Some stability in the oil markets today. And copper, of course, is the commodity in focus for us this morning on that threat of 50% tariffs from President Trump. Up 1.4%, I should say down 1.4% in terms of the picture when it comes to the LME, and the price divergence versus the LME versus COMEX stateside is pretty remarkable, of course, with prices soaring yesterday in the US versus the pressure that's coming through on, of course, that listing in the UK, reflecting that global benchmark. Let's check in on the Asian markets, where you've seen reaction again to what we've been hearing on the tariff threats with that August the 1st deadline now set in stone, according at least to President Trump. That's not moving across the benchmark in that region. Just softness of 0.1%. The HSI over in Hong Kong down 0.7%. You had producer prices falling the most in almost 2 years in China. 33 straight months now of weakness when it comes to factory gate pricing. Nikkei over in Japan is currently up 0.2%, and the Japanese yen at 147. So President Trump is pushing forward with his aggressive tariff regime, stressing he will not offer additional extensions on country-specific levies set to now hit on August the 1st. He's also indicating he could announce substantial new tariffs, as we mentioned, on imports of copper and pharmaceuticals.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%.
OK, for more, let's bring in Bloomberg's news desk editor Gilts. Jill, there was a flurry of comments, of course, in Cabinet yesterday from the President and some posts on social media. But moving the market, certainly in the metal space, is copper. What does it mean, the 50% threatened tariff on copper imports into the US for that market?
Yes, Tom, this is quite significant. I will point out, first of all, this has been fairly highly telegraphed. We have heard rumblings from Trump in the past about potential tariffs on copper, but I do think this marks, if he goes ahead with trying to pursue this type of tariff, a pretty substantial broadening of, a group of duties that he's really taking to metals. Obviously, he spent much of his term already focusing on steel and aluminum markets. This would mark, I think, a pretty broad expansion, adding copper. I mean, this would come at a time, Tom, Tom, when you've got not just the United States, but the rest of the world is, really been focused on, in particular, imports of copper. It's really important for a ton of different industries. You're looking at, data centers, automobile companies, really kind of, fueling, really important processes and industries, particularly as, some of these companies build out, electrical grids, electrical vehicle markets, that kind of thing. So to have Trump kind of come out now, it seems that, that his administration is saying that they've completed their investigation. They're quite seriously considering this. I do think, that poses a pretty significant advancement of, what Trump has already done in the way of trying to issue levies for, really important metals.
We have also been hearing, of course, from the President of the European Commission, Ursula von der Leyen, speaking about the need to rebalance trade between the EU and China. Let's take a listen.
If our partnership is to move forward, we need a genuine rebalancing, fewer market distortions, less overcapacity exported from China, and fair reciprocal access for European business in China.
So, Jill, from Trump's threats of 50% tariffs on copper to the broader negotiations between the EU and the US, where do those conversations stand? Because yesterday we were talking about reporting that potentially the two sides could lock down a deal as soon as this week. Does that now look less likely?
Well, Tom, I think the issue with trying to figure out what any of these deals ultimately look like before they're announced, and quite frankly, sometimes after they're announced, is that Trump is often very, very difficult to predict. So, yes, I mean, yesterday we were hearing that what the deal looked like was potentially 10% across-the-board tariffs, involving the EU, something that, we did see a bit of optimism over yesterday. I think now it seems that some of the conversation is ultimately coming down to whether Airbus would ultimately be exempted from those tariffs. That's been a pretty critical point of focus for the EU, just because Airbus, as the world's largest commercial jetliner, is really kind of, emblematic of a lot of the really complicated supply processes and mechanics of how the bloc sort of works with each other. Maybe that's still on the table at this point, but I would also point out that when it comes to Trump world, nothing is really final until it's final. Just look at the way that he's been characterizing a lot of these talks just now, and, just today versus yesterday. I mean, yesterday he was talking about how this August 1 deadline was not 100% firm, it's firm, but not 100% firm. And now he's kind of, walking back on that a little bit, and I think trying to posture a little bit more strongly. So I think it just kind of shows that when it comes to negotiating with Trump, all of this can be really, really tricky. Maybe the EU still ekes out a deal that's more, favorable to it than maybe what we originally saw with some of those Liberation Day tariffs back in April. But I do think that it does kind of indicate that there's still, something that they need to focus on. But again, I think for the EU, at the very least, Airbus is a really, really critical component of this to really protect.
OK, we'll see if they get that carve-out, of course, for Airbus. Bloomberg's Jill Desis, thank you, with the update in terms of how those negotiations are proceeding between the EU and the US, of course. Meanwhile, back to the copper story, because Trump's comments, of course, as Jill was mentioning, led to that record spike in US copper futures, sowing chaos in markets for the metal. Martin Ritchie, our metals and mining reporter, joins us now. Martin, how big a moment is this, then, in the metal market that you have covered for a number of years, of course?
It's a very big moment. I think Jill, who was speaking earlier, is absolutely right. This 50%, the tariff on copper was well telegraphed. Trump's been talking about putting levies on imports of copper since February. He said he wants to bring copper home. Make of that what you will. But the 50% level is what is the surprise here. The market was really pricing in, and analysts were broadly expecting a 25% tariff. So this is significantly higher than expected, and it's really got people a little bit on the back foot in terms of scrambling to understand what's going to happen next. The reason why 50% is considered very high is because the US is actually particularly reliant on imports for its manufacturing industries, far more so than in steel, for example. So it is going to leave certain pockets of manufacturing potentially in the US potentially facing much higher costs. For the copper market, in the interim, we've seen that kind of flare up in the spread of the US price over the global London Metal Exchange price. It went up to a record of 25%. The US market is reasonably well supplied in the short term because traders have been sending a lot of metal to the US in recent months ahead of tariffs. That trade's now closed. So there's copper in the US, which will kind of soften the impact in the immediate term. But in the long run, I think people are asking, where's this US copper going to come from?
And on that point, Martin, you talked about the inventory build-up in the US as traders kind of foresaw potential tariffs. Copper prices then hitting a new record yesterday in terms of the pricing and the session yesterday. What are analysts telling you about where that pricing story goes from here if these tariffs of 50% are in fact implemented?
Well, you've seen the immediate impact in the US with the price spiking. But I think what's interesting is that the LME prices actually come down a little bit. That really speaks to the idea there's going to be a little bit less pressure on the rest of the global market if major producers have to divert metal away from America. In the US, there was an interesting point from Macquarie in one of their comments this morning, saying that 50% is a level where it starts to become demand destructive in the US. It's going to put off buyers of copper-containing goods if manufacturers try and pass on those costs. So you might see it as actually bearish to some extent, even for the US prices in the next few months.
OK, Bloomberg's Martin Ritchie, thank you very much indeed on the ruptures in the copper market on the back of these threats. Citigroup saying this is a watershed moment for the copper market. Now to China, where producer prices fell the most in nearly 2 years in June, deepening the country's factory gate deflation and overshadowing a modest improvement in consumer prices. Bloomberg's Valerie Teitel is here with more. So, Val, CPI picked up a little bit more than expected. You had some upside there versus estimates of a little bit more pressure on consumer prices. But really, the attention is drawn to producer prices, a 33rd month of softer pricing. Deflation remains in China.
Yeah, deflation remains in China. And now there's just more signs that these producers in China are suffering from overcapacity, showing up in some key sectors such as computers and electronic equipment as the Chinese economy, buckles from these new U.S. tariffs. That PPI did come as a miss. It was estimated to come at 3.2%, printed at 3.6%. And that's the lowest reading in 2 years, Tom, as you mentioned. And take a look at this next chart. You're right in mentioning that this PPI deflation has been a part of the Chinese economy for a long time. For 33 straight months, we've been in deflation when it comes to these factory prices in China. Some speculation that there might be more stimulus to come. There was even the FT reporting last week that the PBOC, the central bank in China, has been discussing with European lenders about their experience with zero interest rates. So it really does show you the momentum for more stimulus, both on the monetary side and on the fiscal stimulus side in China. But we also need to keep our eye on what's going on with global fixed income, Tom. It's been a bruising week for long end bonds. Take a look at the 1 week move in these 30-year yields across the globe. Some of that led by the UK last week. We saw that abrupt rise after those chancellors' motions in Parliament. But this week has also been about Japan. A lot of attention more now on the upper house elections, the possibility of more fiscal stimulus really pressuring those long end yields now globally. And it might not be done. We do have a lot more supply to contend with. Starting with today, we have 10-year gilts, long end German bunds, and 10-year treasuries. And then tomorrow, the big one, we get the 30-year treasury auction as well as 20-year Japan. So still a lot more supply for this market to digest. But the momentum is for lower in price, higher in yield on these long end bonds.
OK, the supply testing the markets once again. Bloomberg's Valerie Teitel, thank you for breaking that down for us. Here's what else to think about in the day ahead. ahead then. 10:30 a.m. UK time, the Bank of England will publish its financial stability report, so a gauge there in terms of the health of the major banks here in the UK. At 3 p.m, Samsung will unveil its latest Galaxy smartphone, and at 7 p.m, we will get the FOMC minutes. The minutes from the Federal Reserve's most recent meeting, giving us more details in terms of the thinking of Fed officials. Markets pricing in just under 2 cuts now by the end of the year, 48 basis points. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Thermal subscribers can go to DAYB Go. And of course, Trump and tariff threats are front and centre. Coming up, OPEC Plus ditched its defence of oil prices in a grab for market share over the weekend. We are in Vienna at the OPEC seminar with more details in terms of how OPEC Plus is thinking about oil on the market and price and demand going forward. Plus, later in the show, we will take a deep dive into how German industry is navigating the tariff uncertainty with Oliver Richtberg from the German Engineering Federation. That's coming up. This is Bloomberg.
Tech is integrated into every aspect of our lives, from finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Tom McKenzie in London. Watch Bloomberg Tech Europe. New episode Friday, only on Bloomberg Television.
Welcome back to Bloomberg Daybreak Europe. Now, oil prices held steady as traders weighed signs of swelling US crude stockpiles and the fallout, of course, from President Trump's tariff regime. It comes after OPEC Plus ramped up output over the weekend in that battle for global market share. Joining me now from Vienna, where the OPEC seminar is taking place, is Bloomberg's Jemana Besetchi. Jemana, what are then ministers thinking about post that decision? Pretty dramatic, of course, to put more oil on the market. What is top of mind for OPEC ministers at this seminar?
Yeah, well, most certainly oil prices are going to be top of mind. But let me just bring you the space of where we're standing right now. This is the Hofburg Palace behind me, where the OPEC seminar is set to take place. And by the way, this OPEC seminar takes place actually every 2 years. It's a biannual conference organized by OPEC, bringing together some of the biggest OPEC oil ministers alongside non-OPEC oil ministers, some industry leaders as well, CEOs of integrated oil companies, alongside think tanks. So it really is the first opportunity for all of these minds to gather together and talk about some of the biggest pressing issues in the energy space today. I should just say that at Bloomberg News, we have asked for accreditation to go inside the seminar, inside the palace, but have not heard back despite multiple requests. But it will still be an opportunity to hear from some of these senior industry leaders, thought leaders, about exactly what has gone down just the last couple of weeks. And remember, we're coming off that 12-day Iran-Israel war. A lot of geopolitical premium was injected into the price of oil. That has basically been fully unwound now, though there's still some nervousness in the air. And then, of course, you referenced that OPEC Plus decision to bring back extra barrels to the market, another bigger supply surprise to the markets over the weekend. But then again, look at the price of oil this week, and it seems to have taken that decision in its stride. Looking ahead, though, of course, there are going to be bigger questions about what this may mean for the path of oil. And then bigger picture, some of the other conversations that are going on inside here about some of the themes like energy transition, energy security, getting funding for some of these energy infrastructure projects, and of course the big one, Tom, artificial intelligence, how you incorporate technology into some of these energy solutions.
OK, some key topics, of course, and questions being debated then in the grand halls of the Hofburg Palace behind Jemana. Jemana, thank you very much indeed. On the ground for us, of course, in Vienna throughout the day for that OPEC Plus seminar. Jemana Besetchi, our Middle East correspondent. We will be returning to the OPEC seminar a little later in the show when Jemana will be joined by Sarah Emerson of Energy Security Analysis. So more insights into what is next for these oil markets with more barrels being put, of course, to play by OPEC Plus. Coming up Bloomberg learns that SpaceX is looking to raise funds at $400 billion. It's the largest ever valuation for a privately held US company. More on that SpaceX scoop next. This is Bloomberg.
I think we have obviously we have an incredibly talented team, and I think they really love what they're doing. Obviously, some people will go to different places. There's a lot of excitement, I guess we could say, in the industry, but no, I think we feel fine.
The OpenAI CEO, of course, Sam Altman, on retaining talent after saying Meta had been trying to poach his company's staff. Now, Bloomberg understands that SpaceX, meanwhile, is in talks to raise new funding in a deal that could value the company at around $400 billion. That would be the largest ever valuation for a privately held US company. Let's bring in Bloomberg Transport and Aviation reporter Danny Lee for the context and the details. Danny, you follow SpaceX. How far along are these talks then? And what is behind and supporting this potentially $400 billion valuation?
Well, these talks are in discussions so far. So this indicates this is at an early stage at the moment. But this $400 billion valuation, this would, compared to last year where it was valued at half of that. So, this new high watermark could make it the most valuable for a privately held US company. So talks are ongoing, particularly between SpaceX and its potential investors. But when you look at the SpaceX as a rocket and satellite company, it is already reaching many new heights, frankly. And when you look at its Starlink business, it's making broader inroads into defense and commercial entities. And we've heard a lot more of airlines linking up with Starlink satellites in particular. And this is why Starlink has half of its revenue for SpaceX, half of its revenue comes from Starlink. And of course, we've seen for SpaceX its work around rockets and has basically become the go-to for the US government, although of late it has had some troubles with its rockets and some explosions on testing. So clearly there is a broader play here to see whether someone like SpaceX can push beyond some of these current challenges.
And you talk about the government, Danny, and that makes me think, of course, of the spat now between the fallout between Elon Musk and President Trump. Is that potentially a roadblock, or at least a headwind, a challenge to SpaceX and its ambitions?
Well, this is definitely the kind of elephant in the room, the potential challenge that SpaceX and for Elon Musk faces. This $400 billion valuation, is this priced into its relationship with for Elon Musk with Donald Trump and the relationship with the US government, or is this moving beyond that, so to get to this new high watermark? And I think this is something that investors will weigh when they think about its relationship not just with Elon Musk, the potential success and exposure of something like SpaceX, and then also that kind of gambit, this potential windfall that investors could enjoy with that exposure to Elon Musk, and the fact that its businesses are doing generally very well in terms of SpaceX. So that's something very much for investors to weigh up and decide.
OK, Bloomberg's Danny Lee, thank you very much indeed with an update in terms of the latest valuation for SpaceX. Now, some other stories making the news. This Wednesday, Bloomberg understands that Meta, meanwhile, has bought a minority stake in the world's largest eyewear maker as it deepens its commitment to smart glasses. Sources say Meta has taken a 3% stake in EssilorLuxottica, worth around €3 billion. The two companies have already partnered over the years to develop AI-powered smart glasses. And longtime Apple Chief Operating Officer Jeff Williams is stepping down later this month, making and marking a major change of the guard for the iPhone maker. The company says he will hand his post to Deputy Sabir Khan before retiring from the company later this year. Coming up, we're going to dig into how German industry is navigating the tariff uncertainty with Oliver Richtberg from the German Engineering Federation. What are his members saying about margins and about navigating the tariff uncertainty? That's coming up. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. No more extensions. Donald Trump ramps up his trade war, threatening 200% tariffs on pharmaceuticals and 50% on copper. The metal's US futures jumped the most on record. Emmanuel Macron warns of hesitating alliances as he says the UK and France have a special responsibility for Europe's security. Plus, UniCredit ramps up its stake in Commerzbank to 20%, becoming the biggest shareholder in the bank it hopes to take over. Let's check in on the markets then. Renewed tariff uncertainty, of course, but the markets have been able to largely see through this. European markets pointing higher for a third straight day. You've had 2 days of gains, modest gains for European stocks, pointing higher on the European stocks 50 futures by 0.2% this Wednesday morning. FTSE 100 futures also modestly higher by 0.1%. The US markets closed essentially flat yesterday, and today the S&P E-minis are pointing low by about 0.1%, and a similar picture on the Nasdaq 100 as well. A need for the next catalyst, it seems, for the US markets. Let's flip the board and have a look across asset. You've seen selling pressure across treasuries again, particularly at the long end, and that is not a unique story. You're seeing that globally, of course, here in the UK, in Japan as well. A lot of issuance coming through this week. The 10-year, the benchmark stateside, currently 441, yields up close to 2 basis points. You've seen 5 straight days of selling across US treasuries. Again, the 30-year closing in to 5%, closing close in to 5%, 4.9 right now. Euro dollar at 117, a little soft on the single currency by 0.1%. Brent is trading down 0.3, and copper, of course, in focus on the threat of 50% tariffs, with LME pricing down 1.5%, diverging from a record pop in copper prices stateside. Now, Bloomberg has learned that the European Commission is closing in on a US trade deal that could exempt commercial aircraft from some tariffs. It would also create carve-outs for some, mostly German car makers, giving relief to companies such as BMW and Mercedes-Benz. For more, we are joined now by Oliver Richtberg, who is head of foreign trade at the German Engineering Federation, the VDMA, representing a few thousand members across Germany. And, of course, the US market is crucial for your members. Oliver, thank you for taking the time. What is your reaction to these potential carve-outs? Is that good news, or are you pursuing and pushing for a deal that leads to lower tariffs more broadly across the benchmark when it comes to Europe and the US?
Good morning, Tom. So for us, every time an exemption of tariffs is in the picture, we are in favor of that. So for us, what we prefer, of course, would be like an exemption from all the tariffs, so lower the tariffs to 0%. Let me say that our industry, we export around 80% of our products outside of Germany. So for us, tariffs are like poison. So in the best world scenario, we would cut down the tariffs on all the sectors. But of course, we live in the real world. So whenever there's an exemption in the picture, we would favor that. Our industry, they deliver machines to all of the other industries like aviation that you mentioned. So this would be good for us too. So if we couldn't have any other trade deal, we would take that.
OK, you'd take that. Would you also take 10% as a baseline tariff, Oliver? What would, as you say, it seems very unlikely we get to 0. So 10% seems to be the minimum in terms of the benchmark rate and tariff that the US is prepared to propose as part of this deal. What would that mean for your members?
So what this means for our members, we asked them. We did a big survey in the beginning of May, and we asked them, what do the tariffs mean for you? And what they said to us is that the uncertainty that the tariffs created is greatly impacts them. 80% of our members said that the uncertainty it creates is much worse for them than the 10% tariffs itself. Only 40% said that the 10% tariffs greatly impacts them. So for our industry and for business, the uncertainty is much worse than the tariffs. And to be realistic, I think 10% tariff is the new baseline. It's what we heard from Washington all year. We've been there in April. So we will take the 10% tariffs over the uncertainty that not knowing where we are going is going to mean for our industry.
What does it mean for margins in that scenario, Oliver? Do your members, do they absorb that hit to the margin, or are they going to have to pass on some of that cost?
So this is, I have to say, this is a difficult question for an association, because you always, when you talk about prices and who's going to take them, you talk about compliance issues, and for good reason. But when we were in the US and we talked to our members and their customers over there, they both said, because machines can get very expensive, you can be in the high seven figures numbers. And then if you talk like 10% or 25% tariffs, it gets to a very high number. So when we talk to them, neither said they have the margins to swallow the tariffs. So I think it's a discussion between customer and producer in every single case, and it's not easy for anyone.
Are you hearing from any of your members a willingness to commit more investment in the US? That is clearly what President Trump wants. He says, if you want to be able to ship into the US, come and build and set up a factory here. Are your members prepared to do that? Are you seeing any moves to commit more investment to the US?
So right now we don't. Every member of us and all the customers, they have paused on the investment because of the uncertainty, as I mentioned in the beginning. And for our industry, around 90% of our members have less than 250 people, employees. For them, it's just not economically viable to manufacture in another country. So for 90% of our members, this is pretty much out of the picture. And our bigger members, they already invest in the US, and they have they employ people there. We have around 100,000 people we employ there. And for them, they told us, because the US market is so important for them, they wanted to invest more. But we have a lack of qualified workers in the US, and this is what makes it very hard for them to invest even more. So I think there have to be some steps taken by the US administration before companies will invest more over there.
Yeah. Oliver, before we let you go, what does all of this mean for the competitiveness of German industry? You have energy costs 3 times that of the US, labour and the cost of labour and the inflexibility of the labour markets, and then additional tariffs. What does that mean in terms of the competitive dent more broadly for German industry?
So for the US, it feels like that all the competitors are getting tariffs too. So in the US, I would say it doesn't mean anything for our competitiveness. Of course, as I mentioned, we depend so heavily on exports, and if we in the European Union get tariffs, and tariffs that might be higher than those of our competitors, which sit mainly in Asia, I have to say, this would be really problematic to us, because the US is our single most important export and investment location. So we have to see. I read today that we will get a letter in 1 or 2 days. So let's see whether tariffs are going to be in the end.
OK. Oliver Richtberg, head of foreign trade at the German Engineering Federation, the VDMA. Thank you, Oliver, for those insights. Now, French President Emmanuel Macron has warned that Europe faces hesitating alliances during a speech to the British Parliament yesterday evening. Macron, on his first state visit to the UK, also pushed for closer ties between Paris and London, calling for an end to excessive dependencies on both the US and China.
At this bilateral summit, we will enter a new stage that will scale up this cooperation. And we are faced with new threats, with aggressive nuclear powers, with sometimes hesitating alliances, and the return of major conflict on our continent. There is an expectation in Europe that, faced with revisionist neighbors, our 2 countries have a special responsibility for the security of the continent. And it is time to articulate it.
OK, I'm joined now by Bloomberg's Alex Morgan, who's been following this state visit, this presidential visit to the UK, which, of course, continues. What kind of stands out to you in terms of the comments from Macron in this pretty long speech to parliamentarians here in the UK? What stood out to you in terms of the importance on key issues?
I think, Tom, what we're going to be moving from today, from this morning onwards, is from the pomp, the pageantry of yesterday, even that address to both houses of Parliament. It's a rare thing to see, a foreign leader making that address. Away from the sort of more pomp and pageantry to the kind of hard, practical political issues. Because while, of course, Emmanuel Macron there was talking in broad terms about the themes, the global challenges, the need for the UK and France to deepen the ties, may the channel not grow wider. Now, this afternoon, there's a bilateral summit between Keir Starmer and Macron where the channel will be one of the big issues that those two will have to talk about, these small boat crossings. Tomorrow, we have the so-called Coalition of the Willing meeting by video conference, and that's where talk of so-called hesitating alliances and revisionist neighbours translates into practical questions about what is Europe going to do for Ukraine if, say, for example, the United States might continue its current position, or there might be questions in the future about Europe and other countries needing to do more. So this sort of shift then from the pomp, the pageantry, from the state banquet last night where the king spoke in both French and English, talking of the entente, the friendly partnership between the two countries, Macron again repeating these sort of broad, warm words, to the practical political meetings. Today with the Prime Minister in Downing Street, tomorrow with this meeting then of the coalition of the willing. And I suppose in a way this is a state visit about these two leaders. It's about Macron and Starmer, but it's about the two men who aren't there. It's about their shadows. The shadow of Trump cast across questions of trade, of course, and security, and the shadow of Vladimir Putin as well, particularly that's going to be cast across those meetings tomorrow. OK, so the positive mood music is there now. It needs to be translated into actions and outcomes. Alex Morgan, thank you very much indeed, covering, of course, this presidential state visit to the UK that continues, of course, through the rest of this week. Now, to the banking space. UniCredit has increased its equity stake in Commerzbank, becoming its largest shareholder after converting derivatives into stock. The move gives the Milan-based lender about 20% of the effective voting rights of its German rival. Let's bring in Bloomberg's deal reporter, Manuel Baigorri, for the details on this. We could see this coming, Manuel, but nonetheless, this is a moment, isn't it, in terms of European banking. Commerzbank, of course, seeing this stake being taken in 20%. It's official now by UniCredit. Commerzbank saying this step was taken without its agreement, though, even though they could also see this coming.
Definitely, Tom, fascinating move. Another step into that consolidation moves in European banking, as you well said. Yes, definitely without their agreement, but I agree with you that they saw it coming because obviously it was in everybody's mind and it was quite public that UniCredit has been pursuing building a stake into the German lender. Obviously, Commerzbank wants to reiterate that they remain committed to executing their business plan, and they would prefer to remain as a standalone bank and remain independent. But obviously, as a publicly traded firm, they are also subject to potential offers. So it remains to be seen how this will pan out. Obviously, there is a lot of dynamics here in place.
Manuel, how does UniCredit navigate around the German government? It's quite a sizable obstacle to this deal. A German government that talks about wanting banking union, except, of course, when it comes to Commerzbank. What's the game plan for UniCredit?
Yes, so as we saw last month, there was a letter sent to some government officials to try to persuade them or lobby them into the benefits of further consolidation between European lenders. This idea of creating pan-European champions in the industry. Obviously, there is being opposition from Commerzbank and also from politicians in Germany about such move, but for UniCredit, they remain committed to the plan of trying to build their position and potentially combining the two entities. Remains to be seen what the next steps will be. Also, bear in mind that Commerzbank's stock has been surging since the whole plan between the two became more public around September last year. So that has made any potential acquisition or combination more expensive for UniCredit. So, in that time or that interim to see where the stock or the price may end up being, under our shell and UniCredit will surely, try to convince and such, regulators and politicians and everybody at Commerzbank that this deal makes sense.
OK, we'll see, of course, if Orchel can make that case. Bloomberg's deals reporter Manuel Baigorri, thank you for that update. Coming up, we're going to go back to Vienna for the OPEC seminar and speak to Seraph Emerson, founder and president of Energy Security Analysis, for views on the evolutions in these oil markets. That is next. This is Bloomberg. Let's return to the oil story now and rejoin Bloomberg's Jemana Pasechi, who's on the ground for us in Vienna at the OPEC seminar. Jemana.
Good morning. Yes, Tom. So we're here just outside the Hofburg Palace, which is where the OPEC seminar is taking place. We are not reporting from inside. We've asked for accreditation, but have not received a response yet. But I'm happy to say, as of now, I've got Sarah Emerson, the president of ESAI Energy, with me to discuss everything, really, that's going to be taking place inside the seminar the next couple of days, some of those longer-term conversations about the path of energy, but then also short-term dynamics as well. So maybe let's just start there. And the fact that OPEC Plus once again surprised the market with quite a sizable increase in production over the course of this weekend. And yet it seems to be quite well digested by the oil markets this week. You've seen barely any price movement in the price of Brent. Why do you think that's the case?
I think at the moment there's just plenty of demand for oil. We're in the summertime driving season, and so there just is enough demand. And I don't think the increase was that much of a surprise. I think they had telegraphed in previous months that this was a possibility, and then again probably will do the same in September as well.
So this is summer demand. Obviously, seasonals are supportive. Many analysts I speak to seem to think that by the end of the year, the market will be looking a lot more imbalanced, i.e. you will get a big oversupply relative to demand. What's your view there?
I think we're definitely tending towards oversupply by the end of the year. I think that's sort of the consensus view, and I would agree with it. But I think the concern is much more 2026, that this oversupply will begin to hit in 2026. As you know, the market sometimes has to react to the fundamentals, and it'll take a while for the oversupply to begin to appear. Then it appears and the market begins to respond, and I think 2026 could actually be the weaker period.
One of the reasons for, or justifications, I should say, for OPEC Plus to decide to put more barrels back to the market, they say is market fundamentals, but many analysts we speak to say that it also is an opportunity for OPEC Plus to reclaim back market share because they had been withholding barrels from the market. Where is that market share going to come from?
Oh, that's a good question. To my mind, I think this started out as sort of a tactical decision. Let's add a bit of capacity back to the market over a long period of time. And in that case, we will be somewhat disciplining the overproducers within OPEC Plus. We'll be encouraging the compensation plans. And then I think it's in the last month or two, it sort of has morphed into more of a strategy, which, as you say, is to take back some market share. And I don't really think it's so much that it's taking market share as it's preparing the market in case there's some reduction in sanctions on Russia, Iran, Venezuela. And so it almost makes more sense. It's a logical decision, is how I would put it. Is why would you hold production off the market when there's so many things that can change?
Yeah, but it seems as though if there are going to be surprises, it will likely materialize on the supply front because, as you say, the non-OPEC supply is building, and then there's also the possibility of some of the removal of sanctions as well. Exactly. In that scenario, what do you see happening to the price of oil, given your forecast for 2026?
We see oil prices falling, but not dramatically. I mean, remember, the price mechanism works. We're going to see a little bit more demand. We may see it in U.S. stocking of the SPR. We may see it in a little bit higher refinery throughput. We may see it in growing inventories. We may see it in more direct burn of crude. So there are a number of ways in which crude demand could inch its way up. On the supply side, I think probably we're going to see a decline in U.S. shale. Yeah. We are not seeing the same size growth in Brazil as we were talking about a year ago. So we are seeing modest growth in Canada. So I think the market does equilibrate. It'll just take some time, and it'll probably take lower oil prices than we have today.
So President Trump has talked about wanting to see lower oil prices, but too low oil prices obviously puts the drillers out of business. What do you think is the sweet spot?
That's an excellent question. You can't have both. You can't have low gasoline prices and high prices for shale producers. So there is a sweet spot. It's hard to say exactly where it is. I would say we're close to it at the current price, or at least in the 60s for Brent. And I think this is just a tension in his policies, like many other tensions in his policies.
Yeah, obviously markets keeping a close eye on how the tariff talk plays out as well. Sarah, thank you so much for joining us.
My pleasure.
Sarah Emerson, president of ESAI Energy, talking us through, just some of the recent dynamics in oil markets, but also a look ahead to the coming months and that potential for more supply to hit. Tom.
Yeah, really interesting views on the oversupply by the end of this year, but maybe 2026 being really the year when that oversupply hits home. Bloomberg's Jemima Pasechi on the ground for us at the OPEC Plus seminar with that analysis, of course, in Vienna. Jemima, thank you. There's a lot more coming up. Stay with us. This is Bloomberg. Welcome back. Happy Wednesday. Dr. Copper then in focus for us today with these threats of 50% tariffs, of course, of that essential industrial metal coming through from President Trump. And here is the cost premium in terms of the pricing for this metal in the US versus the benchmark, of course, and the pricing on the LME. About 30% more expensive than the LME right now in terms of the COMEX versus the LME. You have seen that inventory surge, of course, in the US markets as traders try to front run this tariff story. But nonetheless, you saw that record price pop, of course, yesterday in the session. So copper, we continue to watch on the back of that story. Let's flip the board and have a look at what's happening in the gilt markets, because the Office for Budget Responsibility here in the UK warning that the change around pension defined contributions versus defined benefits, so we're switching from defined benefits to defined contributions, that is happening, and that means there is less demand essentially for UK pension funds for gilt, and that could lead to additional £22 billion worth of interest costs for the UK government. So this is a big question, of course, for the Treasury. Longer term, we have about 100% debt to GDP right now. The OBR suggesting that the debt to GDP could get to 270% here in the UK in the next 50 years. Let's flip the board and briefly touch in on what is happening. The latest, of course, broadside against Jay Powell from President Trump, who's called him a baby this time, and again, calling him to cut interest rates. The Wall Street Journal, by the way, has a really interesting piece on the two Kevins battling it out to be the next Fed chair. Jay Powell steps down, of course, in May. Kevin Walsh, Kevin Hassett, and their appeal to President Trump to try and get that spot, apprentice style. So that's worth a read as well. But again, President Trump lashing out at Jay Powell, once again describing him as, quote, a baby who should cut interest rates. Now, a reminder that we will speak to the Irish Finance Minister at 9:45 a.m. London time. The opening trade, though, is up next to walk through all of these stories for you. Stay with us. This is Bloomberg.